Bismillahirrahmanirrahim. In this video, we want to talk about the risk, what is risk, and of course, what is the relationship between risk and return, and as well as what are different types of risk. So first of all, we have to define risk. What is risk? A simple definition is given for the risk. Risk is the possibility of loss. One definition. Risk is just the possibility of loss or the possibility of getting less than expected return, right? So let us first explain the first part. Risk is the possibility of loss. Risk means chance of loss in the future. If it is possible to suffer loss in the future because of any reason, if it is possible to suffer loss in the future, that can be called as what? As risk. If it is not possible to suffer loss in the future, so it is called, in this case, there is no risk. As much as the chance of loss is more, risk is more. As much as the chance of loss is less, risk is less. So simply, if someone asks you whether loss and risk is the same or not, you have to say no. Risk and loss is not the same. Risk just means chance of loss, or risk simply means the possibility of loss in the future. If it is loss, so it is loss. Until it becomes loss, it is called risk, right? So basically, risk is in between profit and loss. If it go on the right way, so or on the positive side, there will be a profit. But if it go on the wrong side, on that case, there is a there is a loss for the business. So risk is in between profit and loss. So neither profit, neither, of course, we can say loss. It is just the possibility of loss. Or we can say it is the possibility of getting less than expected return. Let us say, for example, I have invested somewhere and I expect, for example, to make 1,000 profit out of it. How much I have expected? I have expected to make 1,000 profit out of it. If due to any reason, if due to any factor, right? If due to any problem, if it is possible to have profit less than 1,000, less than how much? Less than 1,000. I expect, for example, I expected to have 1,000 profit, but it is also possible due to several reasons to have a profit of 800 but not 1,000. So the possibility of getting less than expected return, this was the expected return, but the possibility of getting less than expected return, so 800 is definitely less than 1,000. So the possibility of getting less than expected return is also called what? Also called risk. If it is possible to have less than what you have expected, so this can be called as what? At risk. Okay? In this graph, I have shown the relationship between risk and return, right? So in this line, I have shown the expected return, but of course, in the horizontal line, I have shown in the vertical it is return, and the horizontal it shows the risk, right? See, basically, there is a direct relationship between risk and return. There is what? There is a direct relationship between risk and direct relationship between risk and return. What do you mean by direct relationship? Direct relationship means if risk is more, return is also more for a particular investment. As much as chance of risk is more, in this case, chance of profit is also more. So this is basically called direct relation between risk and return. So when risk is more, return is also more. It means if you expect more profit, definitely you have to expect more risk as well. On the other side, if you expect less risk, right? If you expect less risk on that case, so there is a chance of less profit as well, right? Let us take example of gamblers. In the case of gambling, risk is more, so definitely profit is also more, or return is also more, right? So both possibility is more. If it go on the wrong side, so definitely risk is more, and of course you suffer loss. But if it go on the right side, it means in this case you make a huge amount of, we can say, income or gain, right? So there is a direct relationship between risk and return. If you want more profit, you have to accept more risk. If you don't want more risk on that case, so you have to accept less profit as well. This graph or this line basically point out that several securities in the market which started from the less risk or zero risk and shows the maximum risk for the security. The first security I have shown a treasury bill. You know what I mean by treasury bill? Treasury bills are the bill which are issued by the central bank on the behalf of the government when the government needs money or when there is a financial deficit. So they may take loan from the market, right? And of course, for that purpose, they issue treasury bills. T stands for treasury, and this is bill. And these bills are not more than 1 year. Bill can be 91 days, can be 182 days, and can be 364 days, right? And it is issued by the central bank on the behalf of the government. Risk for this one is basically this is in this point. This is in this point. Or let me show with the particular line here, right? See, in this case, basically this is in this point. This point. This point, when you go, of course, risk is equal to zero. Risk is equal to what? Risk is equal to zero. Why risk is equal to zero? Because this is on the 0 point itself. Risk starts from here and goes to increase and increase. This might be, for example, this is risk of 0, risk of 5%, risk of 10%. So as much as you go on the right side, risk increase. And definitely as much as you go upper side, return also increase, right? First of all, risk of this one, treasury bill. In the case of treasury bill, as we said, risk is equal to 0. In the case of treasury bill, risk is equal to 0. That is why it is called risk-free security. So risk of treasury bill is 0. Why it is 0? Because it is issued by the central bank on the behalf of the government. So the chance of default is very less. Even in this case, there is no chance of default. And of course, it is for less than 1 year. Definitely, the government may not go for default, right? So that is why it is risk-free security. So as risk is 0, return is also less. For example, return might be, for example, just 5%. How many percentage? Just 5% profit. If you go upper, for example, above that, there's another security by the name of saving and deposit, right? Saving and deposit. What is saving and deposit? Saving and deposit is, of course, in this saving and fixed deposit. When you deposit to the bank, right? In this case, also risk is less, but of course, chance of profit is also less. For example, profit in this case might be 10%. How many percentage? Might be 10%. But risk also might be, for example, 4%. How many percentage? 4%. So as much as you move upward, a risk increase, but return also increase. The first one was risk was 0, but the return was just 5. But if you move upwards, right, in this sequence, so a risk is increase, a return also increase. In the case of government bond, for example, right? In the case of government bond, return might be 15%, for example, right? But there is also a chance of risk. Risk might be, for example, 8%, right? So as much as you move upward, a risk increase and return increase. Risk increase, return increase. So as risk increase and return also increase, in this case, we can say there is a direct relationship between risk and return. Till to reach to the maximum, to the peak point, and that is, of course, for example, future. Future is also one of the security, right? And of course, you can find out the future in forex market. You can find out in the commodity markets. You can find out in any market. This is one of the way of hedging the risk. For example, return of this one might be, for example, 25%. For example, even it might be more than that. And risk also might be, for example, increased to 15%, for example, right? So as much as you move upward, risk and return increase. Treasury bill is the bill which are issued by the central bank. Saving and deposit, when you deposit to the banks. And fixed deposit means for a specific time period. See, after fixed deposit, there is another security. You may ask a question that treasury bill is issued by the government and bond is also issued by the government. Why bonds has more risk as compared to saving deposit as well as compared to treasury bill? As we know, bond is issued for more than 1 year, right? Might be, for example, 2 years, might be 10, up to 10, 20, and so on. So as period of the the bond is more, or it is for more duration, risk is increased. Why? Because even, for example, one government issued the bonds for a particular project, and the second government may not be, we can say, may not accept that project, or even we can say maybe they may reject that project. If this is so, there is a chance of default. Or as it is, we can say length is more, so payment is in the future. Future is uncertain. As much as you go toward future, the chance of uncertainty increase. As much as chance of uncertainty increase, chance of risk also increase. Then after that, you go for the corporation bonds, mutual fund, real estates, options, and so on. I'm not going to discuss all of this, but there's a sequence between these securities. So as much as you move upward, risk increase, and definitely return also increase. So this was a simple point regarding the risk. So once again, what is risk? The possibility of loss or the possibility of getting less than expected return. So there is a direct relationship between risk and return. So if you want more risk, so definitely you can have more return. If you want less risk, so definitely you have to accept less return.